They earned $12,000 a month and still had weeks where their checking account looked like a dare. So here's the uncomfortable question. If two decent incomes can still end in panic, what exactly is your paycheck protecting you from? This is not a story about yachts, designer bags, or private school for the dog behavior. This case study represents real financial patterns and real-world data. Marcus works in logistics sales, Elena manages a small medical office, and together they bring in about $144,000 a year before taxes, well above the latest official real U.S. median household income of $83,730. And if you use current BLS weekly earnings data, two full-time median workers would make roughly $128,000 a year combined. So this couple is not poor on paper. They are above ordinary by the math. But paper is dangerous because paper doesn't swipe, paper doesn't auto-pay, and paper doesn't buy diapers on a Tuesday night. After taxes, insurance, and deductions, their usable take-home pay is roughly estimated at $8,900 a month. Now watch what happens to that $8,900 before the month even has a chance to breathe. Rent for a decent two-bedroom in a fast-growing U.S. metro, about $2,350, estimated. Daycare for one child, about $1,200 a month, estimated. And suddenly, we both work starts sounding expensive. Two car payments, $1,140. Insurance, gas, and maintenance, another $720. Groceries, $900, and that's with them pretending the snack aisle doesn't exist. Takeout coffee and the tiny we deserve this purchases, around $640. Phones, internet, streaming, gym, and subscriptions they barely remember signing up for, about $410. Utilities, student loans, and minimum credit card payments, another $1,080. And just like that, they're basically out of money before birthdays, doctor visits, school events, tires, weddings, or life doing what life does best, showing up uninvited. Here's the part that hurts. The average U.S. consumer unit spent $78,535 in 2024, with housing taking 33.4%, transportation 17.0%, and food 12.9% of the budget. Marcus and Elena weren't just overspending on random nonsense. They were getting crushed by the same categories crushing almost everyone, just at a slightly more expensive setting. That's why this story matters, because broke no longer means reckless. It can also mean fully employed, socially normal, and quietly drowning. In May 2026, consumer inflation was still running at 4.2% year over year, with shelter up 3.4%, food at home up 2.7%, and food away from home up 3.5%. So even when they felt like they were buying the same life, they were paying more for it every few months. And because their margin was gone, every increase hit them twice, first in cash, then in stress. Their budget wasn't a budget. It was a horror movie with autopay. When they came up short, they didn't borrow for vacations. They borrowed for groceries, school supplies, and the kind of ordinary month nobody posts on Instagram. And that is how middle-class debt gets built. Not always from luxury, but from routine life financed one swipe at a time. Right now, Americans owe about $1.252 trillion on credit cards and about $1.685 trillion on auto loans, while total household debt sits near $18.8 trillion. And when you stack a fragile monthly budget on top of a country already leaning on debt, you stop asking, what's wrong with me? And start asking, how many people are one bad month away? The average commercial bank credit card rate on all accounts was about 21.0% in early 2026, and on accounts actually being charged interest, it was even higher. So their $11,400 revolving card balance wasn't just sitting there. It was quietly charging them roughly $200 a month in interest alone, estimated. Then came the week that broke the illusion. Daycare cleared, 2 auto payments hit, a tire blew out, and their checking account fell below $100 before payday. Not zero. Not negative. Somehow worse. Because under $100 is just enough money to create hope and not enough money to solve anything. That night, they finally did what scared people avoid. They printed statements, opened every app, and added up the little leaks they kept calling normal. They discovered the real villain wasn't one giant mistake. It was 10 medium-sized conveniences pretending to be harmless. They had been living like people with a safety net, even though they had no emergency fund at all. And with the U.S. personal saving rate at 3.0% in May 2026, they were painfully ordinary in the worst possible way. So they made one rule that changed everything. No more borrowing from next month to survive this month. Not "we'll be perfect." Not "we'll never eat out again." Just one rule. If cash wasn't there, the answer was no. First, they cut the invisible stuff: unused subscriptions, premium phone plans, random online shopping, and convenience spending that never felt big because it arrived in small doses. Then they attacked the fixed cost monster. They sold one newer car, bought an older, reliable replacement with cash from savings they scraped together, plus help from selling extras, and lowered the monthly drain. That one move was not glamorous, but glamour had been costing them hundreds every month. They cut takeout from about $640 to around $220, capped grocery spending with a real list, and stopped treating stress like a reason to order fries. They sent money to savings on payday instead of waiting to see what was left, because what was left had always been nothing. Within 10 weeks, they built a starter buffer of about $1,800. Within 12 months, their monthly margin improved by roughly $1,800. Their credit card balance fell from about $11,400 to around $2,900, and their emergency fund reached roughly $6,000. Estimated, realistic, not magical. They were not rich. They were not debt-free. They were not one viral side hustle away from Bali. But they could handle a tire, a doctor copay, or a bad week without turning the next month into collateral. And that's the transformation most people actually need. Not fake millionaire energy, just enough margin to stop being scared of Tuesday. Here's the lesson nobody loves hearing. Your income matters, but your fixed costs decide whether income feels like freedom or performance art. Another lesson: lifestyle creep is sneaky because it doesn't arrive wearing a villain costume. It arrives wearing convenience. And one more: if you need debt to maintain your normal, then your normal is too expensive. In 2024, households in the highest income quintile spent an average of $150,342 a year, while those in the lowest quintile spent $35,046. Marcus and Elena's trap was simpler. They earned enough to feel safe, but not enough to absorb high-cost habits forever. And if they had tried to solve everything by buying a house instead, they would have met a 30-year mortgage market still hovering near 6.49% in late June 2026. So no, the answer was not a fantasy reset. The answer was boring, adult, slightly painful math. Which brings me to you. If your income disappeared by 20% tomorrow, what would vanish first, luxuries or things you currently call necessities? Because the scariest part of being broke is not having low income. Sometimes it's having just enough income to hide the problem for years. So ask yourself one final question. Are you building a life or just successfully delaying a financial emergency?